If you've ever dreamed about building a real estate empire, but you don't have tenants, tax returns, or a W-2 job backing you, then this video is your blueprint. Because today, I'm going to show you how to scale real estate using DSCR loans, one of the most powerful tools available to modern investors. No personal income needed, no employment history required, no tax returns. Just smart strategy, clean credit, and properties that pay for themselves. By the end of this video, you'll have a step-by-step system to buy your first or next cash-flowing property using DSCR loans and position yourself to scale fast. And the best part? It's repeatable. Let's break it down. What is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. It's how lenders determine whether a property can pay for itself. Here's the formula. DSCR equals net operating income divided by debt payments. So if your rental property generates $2,000 per month in income and your monthly mortgage is $1,500, your DSCR is 1.33. Most lenders want to see 1.1 or higher, but some accept lower ratios, especially if you've got a strong credit score or cash reserves. But here's the real unlock. DSCR lenders don't care about you, they care about the property's ability to generate income. If the deal makes sense, you can get funding even with no job, no paycheck, and no tax returns. In fact, many lenders will underwrite your deal based on projected market rent, not existing leases. That's a huge advantage for new investors buying their first property or a vacant unit. Why DSCR loans are a game changer. Let's compare this to traditional loans. With a conventional mortgage, you're expected to provide 2 years of tax returns, show W-2 income, prove employment, hit strict DTI ratios, and often close in your personal name. DSCR loans flip the script. You can close in your LLC, use the property's income instead of yours, scale without worrying about DTI, access 30-year fixed terms, sometimes even interest-only options, repeat it over and over. You're not capped by your personal finances. You're only capped by your ability to find smart deals. This is how real empires are built, through scalable leverage that works. Step-by-step blueprint to build your empire. Let's get tactical. Form your LLC and business identity. This isn't optional, it's foundational. DSCR lenders prefer lending to business entities. It also makes taxes, accounting, and scaling 10 times easier. Your checklist. Register your LLC. Apply for an EIN from the IRS. Set up a business checking account. Use a professional business address. Create a business email and phone number. Grab a domain and branded Gmail. Use this same identity when applying for business credit. It creates uniformity and credibility. Build business credit and clean up personal credit. Lenders will still pull your personal credit, even for business purpose loans. So your personal FICO should be 660 minimum, 680 is better, low utilization under 30%, no recent late payments or collections, no major derogatories in the past 2 years. To boost your score quickly, use rent reporting services. Add secured cards or trade lines. Pay down revolving balances before the statement closes. Sign up for tools like NAV, Credit Strong, Divvy, or Tillful to start stacking business trade lines that report. This will open doors to no PG business funding you can use later for down payments or rehab. Choose DSCR lenders that work with newer investors. Not all lenders are beginner-friendly. Here are some solid options. New Silver Lending, great for single-family and 1 to 4 unit rentals. Kiavi, accepts projected income and offers fast closings. Griffin Funding, offers up to $5 million with no job history. Angel Oak, works with lower DSCR and high LTV deals. Visio Lending, good for vacation rentals and short-term units. Lima One Capital, for higher-end cash-flowing properties. Silver Hill Funding, offers loans for 1 to 4 units with streamlined underwriting. Compare each lender's minimum DSCR accepted, credit score requirements, down payment percent, prepay penalties, number of properties allowed, whether they allow title in an LLC. Analyze deals using real market rents. Lenders want proof your property will cash flow. Use these tools to pull accurate market rent comps. Rentometer.com, Zillow Rentals, Craigslist, Facebook Marketplace, local property managers. Run your full cost breakdown, estimated rent, property taxes, insurance, maintenance reserves, HOA fees, mortgage payment. You're aiming for a DSCR of 1.1 or higher. If your DSCR is under 1.0, some lenders will still approve you if you have strong reserves or offer a slightly higher down payment. Apply and close your first deal. Here's what happens next. Submit your deal and documents. Lender will order an appraisal. Rent comps are verified. You'll get a term sheet outlining the rate, term, and LTV. If approved, they'll send you the final closing packet. Be ready for 20 to 25% down, 3 to 4 points in origination, some closing costs up front, prepayment penalties, usually 1 to 3 years. Once you close, congratulations. You now own an income-producing asset funded without ever submitting your tax returns. Scale, refinance, and multiply. This is where the empire part begins. After 6 to 12 months, once the property is stabilized, refinance and pull out equity. Use the cash for next deal. Repeat the process. Some investors do this every 9 to 12 months and build entire portfolios in 2 to 3 years. As you grow, start exploring portfolio loans. Use cross-collateralization to buy without new down payments. Leverage business credit for renovations, staging, or Airbnb setup. Here are 2 example deals from investors who made this strategy work. A new investor in Atlanta used business credit to put $45,000 down on a vacant triplex. She closed with Kiavi using DSCR based on projected income. She rented the units in 3 months, refinanced at a higher appraisal, and bought a duplex in Charlotte 6 months later. Now she holds 5 doors. No job, no W-2, no tax returns. A retired contractor in Ohio used DSCR loans to scale from 1 to 12 units in 18 months. He buys distressed properties, rehabs them, rents them, then refinances, all using the BRRRR strategy powered by DSCR. Final action plan. Let's recap your next steps. Form your LLC, clean up your credit, build business trade lines, find DSCR-friendly lenders, run real rent comps, lock in your first deal, scale, refinance, repeat. You don't need to be rich, you just need the right structure, the right loan, and the right plan. Hit like, subscribe, and check the links below for lender options, business credit tools, and resources to get started. You're not just buying real estate, you're building your legacy. Let's go. Bonus section, hidden DSCR loan costs and how to prepare. Let's talk about the side of DSCR loans that no one warns you about, hidden costs. Because the truth is, even the best strategy will fall apart if you're not financially prepared when these surprise expenses show up. This section is all about protection, knowing what to expect so you don't blow the deal in the final stretch. Let's break down the real costs you need to prepare for. Reserves. This one catches a lot of new investors off guard. Most DSCR lenders will require you to show 6 to 12 months of reserves, and that's based on your full mortgage payment. So let's say your monthly mortgage will be $1,700. You may need to show $10,000 to $20,000 sitting in your account, untouched. Some lenders accept personal reserves. Others require funds to be in your business account. A few may let you use retirement funds or brokerage accounts as proof, but the rules vary. Screenshot your statements and prepare this documentation before you apply. Some lenders deny applicants simply because they didn't show proof of reserves on time. Origination and closing fees. Unlike traditional home loan with fixed, predictable costs, DSCR loans can come with 2 to 4 points in origination fees. That's $2,000 to $4,000 for every $100,000 you borrow. Processing fees, admin costs, underwriting fees, appraisal fees, which you pay up front. Some of these can be rolled into the loan, but many can't. You might need $7,000 to $15,000 in upfront funds just to get to the closing table. Prepayment penalties. Most DSCR loans come with a prepayment penalty period, usually 1 to 3 years. If you try to refinance or sell the property during that time, you'll pay a fee, sometimes thousands of dollars. There are 3 common structures. Step down, 3% in year 1, 2% in year 2, 1% in year 3. Flat rate, 1 fixed penalty if you exit early. Yield maintenance, more complex, ties your penalty to market interest rates. Why does this matter? Because if you plan BRRRR, flip or sell within 12 months, you need a lender that offers no prepay or a shorter term. Insurance shocks. Another hidden cost, insurance premiums. Lenders will require landlord insurance, sometimes hazard insurance, and if you're in a FEMA flood zone, flood insurance, which can be thousands per year. Properties in certain states, like Florida or Louisiana, are seeing premiums double or triple due to weather risks. Get insurance quotes during the deal analysis phase, not after you're in escrow. A high insurance quote can kill your DSCR ratio and tank your deal. LLC costs and state fees. Since most DSCR lenders require you to buy under an LLC, don't forget these recurring costs. State filing fees, annual franchise tax, registered agent fees. You don't want to wake up 6 months later with a suspended LLC because you forgot a filing deadline. That can put your property and your refinance options at risk. How to prepare for all of this. Create a DSCR deal budget sheet before you even apply. Break it into 4 columns: purchase price and down payment, loan costs and fees, insurance and property reserves, LLC, admin, filing expenses. If you plan on multiple deals, build a master spreadsheet that tracks every expense, lender requirement, and deadline. Investors who scale don't operate casually, they operate professionally. DSCR loans are powerful, but only if you respect the fine print. Most people lose deals not because they weren't qualified, but because they weren't organized or financially prepared. If you get this part right, you'll be light years ahead of most beginners and ready to walk into your closing table like a pro. Why investors get denied. Now let's talk about why investors never make it past the application stage. Because the truth is, most people who get denied for DSCR loans aren't unqualified, they're just unprepared. They didn't know the rules of the game. Let's break down the 5 biggest reasons DSCR loan applications get rejected and how to fix each one. Overestimating market rent. Lenders base your DSCR calculation on actual or projected rental income, but it has to be backed by credible rent comps. If you say a unit will rent for $2,400 a month, but Rentometer Zillow and local property managers are quoting $1,800, your loan just died on arrival. Solution. Always provide 3 to 5 comps to back up your numbers. Use conservative rent estimates, especially on vacant properties. Ask your lender which rent tools they prefer for underwriting. DSCR under 1.0 with no reserves. If your property doesn't cash flow enough to cover the debt service and you don't have cash reserves to back you up, you'll likely get denied. Some lenders will accept DSCR ratios as low as 0.75, but only if you have 6 to 12 months of reserves, strong credit, or a higher down payment. Solution: keep a liquid reserve account. Offset weaker DSCR with stronger borrower strength. Consider buying properties with higher rents relative to price. Brand new LLC with no track record. A common mistake: registering an LLC the same week you apply for a loan. It sends a red flag to lenders, especially if the LLC has no EIN, no bank account, no online presence. Solution: form your LLC at least 30 days before applying. Set up your EIN, bank account, domain, and business email. Have documentation ready so your entity looks credible and real. Missing or mismatched documents. DSCR loans are low doc, but not no doc. You'll need purchase agreement, LLC documents, property insurance, ID and credit authorization, lease agreement or market rent comps, possibly bank statements or P&Ls for reserves. One missing form can stall your file for weeks, so stay organized. Too many recent credit inquiries. Multiple hard pulls in a short period can hurt your score and your credibility. Lenders may think you're desperate, you're trying to stack approvals, or you're hiding something. Solution: limit hard pulls to essential applications. Apply to lenders within a 14-day window so bureaus group them. Use soft pull options or broker portals when possible. DSCR loans are easier than conventional mortgages, but only if you move like a pro. So walk in with the right paperwork, the right prep, and the right expectations, and you'll get funded faster with better terms and way less stress. Best states for DSCR investing. Now let's go state by state, because not every market is created equal, and some states are gold mines for DSCR investors, while others will drain your wallet with taxes, low yields, or tenant laws that work against you. Here are the top 5 states to consider if you're serious about building a portfolio fast using DSCR loans. Florida, explosive growth, short-term rental power, no state income tax, sky-high demand in vacation markets like Orlando, Tampa, Jacksonville. Perfect for Airbnb, midterm rentals, or student housing. Caution: insurance premiums are rising. Always factor that into your DSCR projections. Texas, business-friendly and landlord-friendly. Cities like Dallas, Houston, and San Antonio are booming. Strong job growth, low regulation, and pro-investor laws. Great for both long-term and short-term strategies. Bonus: DSCR lenders love the Texas market for its stable returns and growth potential. Georgia, metro suburbs on fire. Atlanta metro area is expanding fast. Affordable entry prices in places like Stone Mountain, Marietta, and Conyers. Excellent long-term rental yields and tenant pool. Great balance between affordability, appreciation, and cash flow. North Carolina, hidden gem for DSCR loans. Charlotte, Raleigh, Durham, tech hubs with population surges. Ideal for investors looking for turnkey units or light rehabs. Many DSCR lenders are already active in this region. Don't overlook this state. It's rising fast on the investor radar. Ohio, low cost, high yield. Cleveland, Columbus, Cincinnati offer entry points under $150,000. Great for BRRRR or DSCR with light rehab. High cash on cash returns. Investor-friendly eviction process and tax structure. Ohio isn't sexy, but it cash flows. Other DSCR-friendly states worth watching: Arizona, strong appreciation; Indiana, low prices, consistent rents; Tennessee, Nashville booming; Alabama, Birmingham and Montgomery heating up; South Carolina, low taxes, growing investor interest. Choosing markets where the numbers work, but also where DSCR lenders already lend. And make sure to study local ordinances, short-term rental laws, and property taxes before you lock in your deal. The right market can make your first deal 10 times easier. Let the geography work in your favor. Tools you'll need to run your business. If you're going to build a real estate empire, you need more than money and a loan. You need a system. That means having tools that streamline your finances, automate your tracking, and organize your operation like a real business. Let's go over the core tools every DSCR investor should be using, starting today. Business banking and cash management. Bluevine, free checking with high interest and no monthly fees. Relay Financial, budgeting and multi-account flexibility. Mercury, ideal for digital entrepreneurs with clean dashboards. Use these to separate income, reserves, CAPEX, and taxes. Credit and expense management. Ramp, corporate card with no personal guarantee, perfect for expenses. Divvy, expense tracking, budgeting, and business credit building. Brex, designed for startups and fast growth businesses. All three can help you fund renovations, staging, and setup costs without dipping into personal cards. Business credit builders. nav.com, monitor your business credit score, get matched with lenders. Credit Strong, build business trade lines that report. Tillful, free biz credit score tool with secured cards and trade lines. You can use these to grow your profile fast, even before your first property. Rental property tools. Stessa, tracks rental income, expenses, CAPEX, ROI. Appfolio. Buildium, if you scale to multiple units or hire a manager. Rent Ready, DIY landlord management with tenant screening and payment portals. Don't track income in Excel. Use software designed to scale your business. Legal and admin tools. Rocket Lawyer, LegalZoom, LLC formation, lease agreements, legal docs. Gusto, QuickBooks, for payroll, taxes, and clean books. Online check writer, pay vendors and contractors digitally with full control. So here's the bottom line. You don't need a job, a W-2, or perfect credit to build a real estate empire. With the right strategy, DSCR loans give you the power to buy income-producing property, scale fast, and create lasting wealth. Now it's your turn. Hit like, subscribe, and tap the links below to start building business credit, find investor-friendly lenders, and download the free checklist. This isn't about real estate. This is about real freedom. Let's build it.